Good morning. It's Jeffrey Christian of CPM Group. It's about 10:40 in the morning here in New York on Friday, the 4th of April. Gold and silver prices have had a very volatile week. Gold reached $3,196.60 for the June Comex contract, almost $3,200, and then it fell. Yesterday, I think it had a range of about $123. It has fallen further this morning. It's off about $50 as I speak at $3,072. It got down to $3,050. Our downside target for a pullback was and still is $3,050. Talk a little bit more about that later. We'll talk a little bit more about silver too. Silver is off about $1.78 right now. At $30.19 for the May Comex contract. I want to talk about what's been happening with the precious metals prices and also what's going forward. There were two sets of factors that have been driving investor demand for gold and silver up until this week. They're still in place, I have to say. One was the risk, the uncertainty, and the anxiety related to the potential for U.S. tariffs and then counter tariffs from other governments and other U.S. government policies that are likely to have negative economic consequences. Higher inflation, lower economic growth, probably larger fiscal deficits, and a more rapid increase in federal debt, and probably higher interest rates than otherwise would have been the case. There's been a tremendous uncertainty, and there continues to be a tremendous amount of uncertainty, but a good part of that anxiety and uncertainty related to tariffs was dissipated this week on Wednesday when President Trump gave an extended discussion about what tariffs he wishes to impose. And I'll talk a little bit more about that there. The other factor was the April Comex gold futures contract roll. Going into the first delivery date, which was this Monday, the March 31st, you had a very large open interest in the Comex April futures contract. A lot of that has been rolled forward. Some of it has been delivered. And the Comex gold futures contract roll is pretty much behind the market. The economic anxiety has dissipated to some extent. It's still there, and it will be coming back because of a range of uncertainties, including whether or not Congress will block some of these tariffs. The Senate has passed a bill blocking some of the tariffs. The Speaker of the House reacted to that by suspending all votes this week because he doesn't want to have the House vote on that and possibly approve that, which would be counter to the administration's Canadian sanctions. So there's a lot of uncertainty that's still there, and it will rise back, even though there has been some dissipation of the anxiety and the uncertainty going forward. And the Comex April contract roll is really behind. It's the market. It's all but resolved. I'll show you some data in that soon. We had been saying that we thought that gold might find support around $3,050. It got down to $3,060 earlier today for the June Comex contract, which is what we refer to in these videos. There are further declines that are possible. We are seeing massive declines in stocks and bonds, and the dollar has shown weakness. Copper is off sharply. Platinum, palladium, other industrial commodities are off sharply. The premium the risk premium related to tariffs on some of the commodities has also come off because of the exemptions that have been announced in the Trump's stated plans as they now stand. From a longer term perspective, beyond the next couple of weeks, nothing's really changed. And we still have a bullish outlook for gold and silver over the next couple of years, given that. I want to look at the tariffs because while there's some reduction, it still remain unclear. This paragraph here is from the White House fact sheet, which was released on Wednesday, which spells out what the administration's plans are for tariffs. This paragraph related to issues, commodities, and other manufactured products, imports that would be excluded from the tariffs. You can see steel, aluminum, autos, auto parts, copper, pharmaceuticals, semiconductors, lumber, bullion, all articles subject to further Section 232 tariffs. I'll get back to that. Also, the first point, articles subject to 50 U.S. Code 1702B. I'll get back to that in a second. Energy and other certain minerals that are not available in the United States. That's what they're exempting. Economists estimate that approximately 1/3 of all U.S. imports will thus be exempt from tariffs, including bullion, which is not defined here, but most likely means at least refined gold and silver. Whether or not unrefined gold and silver coming into U.S. refineries is exempt is not clear yet. More clarity is needed. Now, what is USC 1702B and what are Section 232 tariffs? These are things that give the administration, the president, total discretion to add things to the exemption list or take things off of the exemption list. So there's a tremendous capacity for things to change. But as it stands on Wednesday evening, bullion was exempted, as were copper and steel and aluminum, which is one of the reasons why you've seen the prices of those commodities fall, because some of that risk premium has disappeared. I want to stop here and talk about our I'll talk about our longer term view later. This is Comex gold inventories. They are at record levels. As of 2 days ago, the most recent data that we have, combined total inventories were 45 million ounces. That excludes the 1.9 million ounces of metal that meets Comex standards in Comex registered depositories that is pledged to other things, allocated metal. So just the registered and eligible total 45 million ounces. That's a record, as you can see here. Right? So right now, the Comex is not running out of metal. That's important because as I look at what people are reading, investors are reading on the internet, I saw this headline yesterday, Comex seeing massive amounts of gold stand for delivery. Now, it's 5.1 million ounces as of April 3rd. That's the fourth delivery day for the Comex April contract. That's not particularly large. If you look at active delivery months over recent years, 3 million ounces, 4 million ounces is not unheard of. And those larger delivery periods in actively traded months occurred back here where inventories were much lower than they are today. So Comex is not running out of gold, despite what promoters and other people who simply don't know what they're talking about might say. One of the things that I should point out is, what is a delivery on the Comex? When the delivery process starts with somebody who is short the active month. April is the active month for Comex Gold right now. And he can go to the clearinghouse and say, I want to deliver against my short position. I've committed to deliver. I'm going to. And what that he delivers are the depository receipts. He's already registered them with the Comex clearinghouse, or he can register more depository receipts. But he registered warehouse receipts are delivered to the clearinghouse. The clearinghouse the next day assigns them randomly to entities that are long the April contract. It's not a delivery of physical gold per se. It's a delivery of a depository receipt for the physical gold, right? Now, there is a constant flow of gold in and out of these depositories. Some people think that they're static depositories, that the metal is supposed to be there to back the Comex. That's not true. These are working depositories where gold and silver are coming into them on a daily basis and coming out on a daily basis, right? And some of the companies that are short and long Comex futures contracts are commercial entities that want to use that metal. So they will take delivery of the depository receipts, see what they got. If they don't want that particular brand of metal, they'll register the depository receipts the next day. So when you say that there's 5.1 million ounces of depository receipts that have been delivered so far on the Comex Gold April contract, you have to understand the Comex doesn't disclose the redelivery rates. If you're involved in the market, you know that that happens and that there's this constant churn. It's not that 5.1 million ounces of discrete depository receipts have been delivered. It's that 5.1 million ounces of depository receipts have been delivered, some of which have been redelivered and then redelivered once again. So that it is significant that it's 5 million ounces. It's not particularly wildly large compared to other active months over the last several years. And you have to understand these are depository receipts that are being delivered. Because there's 5.1 million ounces of depository receipts being delivered, but that gold's not coming out of those depositories. For the most part, it's being held there. There's 46.4 million ounces of open interest in the June contract right now. A lot of that has depository receipts as collateral against it. We've seen 1 million, we're down to 1 million ounces in the April gold contract. So that roll from the April to the June contract is largely behind the market. And of that 50 some odd million ounces or whatever the number was at the beginning of the delivery process, 5.1 million ounces have been actually delivered against. Almost 10 times as much, 9 times as much, has been actually rolled into the June contract. And 5 million ounces relative to 24 million ounces of registered metal and 45 million ounces of registered and eligible metal. So some of that metal is probably going to be used. Some of it may be held by investors. Some of it may be actually coming out of Comex registered depositories and going to other depositories. We'll have to wait and see, but it's not shaking the foundation of the Comex, despite what people who don't know what they're talking about would have you believe. Put that all together, and as I said, we have thought that the price could drop down to $3,050. It's $3,072 right now. It's gotten down to $3,060 for the June contract. For those of you who look at various spot prices, depending on which spot price you're looking at, we're looking at the actively traded June contract. It could come lower. You can see here, the price of gold was $2,600 at the beginning of January, $2,662 at the beginning of the year, 3 months ago. Could it come back down there? Yes. Will it come back down there? It could. We don't think it's possible. We think there's support at $3,050 because the state of the world is not any better than it was 2 days ago or yesterday when the price almost touched $3,200. We think there's support at $3,050. We wouldn't be surprised to see the price fall lower. We told our clients, investor clients yesterday in a trade recommendation that if they see the price at 3,050 or lower, it's probably a buy opportunity. We'll probably issue a buy recommendation if the price does fall that low. And our expectation on the longer term is still that we will see higher gold prices yet this year and into next year. We may see a cooling off period in the second quarter and the third quarter of this year. There are seasonal reasons for that. There are also political and economic reasons. People have had this high degree of uncertainty as to what's going to happen. Some things may, even if things don't improve economically and politically, domestically and internationally, it is possible that markets will become more acclimated to the new chaotic order and will reduce some of their risk buying of gold. But our view longer term is still for higher prices because of everything that's going on in the world. Looking at silver, silver has May to come. May is the active delivery month for silver. As of yesterday, we had 600 million ounces of open interest in the May contract. That will be rolled forward into the July contract most of it over the course of April. That will apply upward pressure on silver prices. Silver prices have been hit hard relative to gold over the last few days, partly because more people see gold as that financial hedge than see silver. Also, some people were taking profits of silver when it got higher. You have 600 million ounces of open interest in the May contract. We've seen 10 million ounces delivered in April. This is not particularly unusual. April is not an actively delivered month. You have 485 million ounces of silver that is reported to the Comex. Of that, 327 million ounces is eligible, and 158 million ounces is registered. So we think there will be upward price pressure on silver in April, especially in the last 2 weeks of the month. Given that, given the fact that the price of silver has fallen so low, we expect the price to rise. We're not surprised to see the price at $30. We wouldn't be surprised to see it fall to 29 or even 28. Could it go back to where it was at the start of the year, which is $29? Yes. Could it go back to $26? Yes, it's possible. Do we expect $26? No. Would we be surprised at $29? Not at all. So silver continues to underperform relative to gold, if that's the way you want to think about it. But what you're seeing is, as I said, gold is seen as by more people in more parts of the world, gold is seen as the financial asset to use when you're worried about your stocks and your bonds and your currency markets and the state of your economy and the state of your political system. Silver plays that role somewhat, especially in North America, less so in other parts of the world, although there is silver demand in Asia, South Asia, Southeast Asia, the Middle East, and Europe and Latin America. But silver is much more a North American phenomenon. So we are not surprised to see silver prices weaker than gold. Silver is also suffering from the fact that most of the silver is used in industrial applications, and there is a great expectation of much weaker economic activity and manufacturing activity around the world, not only over the next year or so, but really over the next decade or so. And that will limit the growth in demand for silver and other industrial commodities. That's all I have right now. I wanted to talk about two anecdotes. And one of the comments in one of our recent videos was, you don't have to go back to the ancient history of 1980. And you do, because if you don't understand what was going on in 1980, you don't really understand precious metals markets. And I wanted to talk about two anecdotes that apply related to 1979, 1980. Some of these videos we've talked about what is the relationship between gold and silver prices and recessions. And we've said there's no concrete relationship. If you look at the 1973, 74 gold and silver price rally, they peaked. They rose during the recession, and they peaked toward the end of the recession. If you look at 1978 to 1980, gold price and silver prices rose before the recession. And once we got into the first of those double dip recessions in early 1980, they both fell sharply. You can look at 1987 when the gold and silver prices rose and there was no recession. You can look at 1991 and to some extent 2000, 2001 when there were short, shallow recessions. Apologists for the government talk about technical recessions, but they were recessions. Yeah, I don't care if you're going to call them technical. They were recessions. And in each of those instances, you saw gold prices only rise, gold and silver prices only rise after the 1991 recession, and you saw them rise only after the 2000 recession. They actually rose in the years prior to the 2007-2009 recession. They rose for years prior to that. Gold started rising in 2002, silver in 2005, 2004. And they rose through the recession, and they rose after the recession. They only peaked after the sovereign debt crisis in Europe and the United States with the downgrading of the Treasury and the Greek sovereign debt issues being resolved in August of 2011. Silver actually peaked in April of 2011. Gold peaked in September of 2011. So the relationship between gold and recessions and silver and recessions is not clear. But I got an email from an old friend of mine who's retired. He is somebody whose family has been involved in the real gold and silver precious metals markets for generations. Really knows gold and silver as they actually trade and actually flow in a physical world. And he sent me an email and he said, I'm thinking about gold and silver in the current economic environment. And I think it's more like 79, 1980 than it is any of those other recessionary periods or pre-recessionary periods that came afterwards. And I wrote back and I said, I think you're right. We have been looking at those templates. And if you look at where we are economically and politically, it's more similar to 1979 than it is to those other periods. So that's a really important model to pay attention to. Unfortunately, there's a lot of garbage that goes around about what was going on back then. You'll find people saying that the Hunts were trying to corner the silver market. They were not. The Hunts were bullish on silver because they looked at the fundamentals of the silver market and they said this price is going to have to rise. And they bought large positions in physical metal as well as futures and options to take advantage of that rising price. Once they had their positions in place, they felt free to tell everybody else, hey, we're very bullish on silver. And other people poured in and pushed the price higher. The Hunts had a surprisingly low net average acquisition price for their silver. Right? But there's a lot of garbage about what was going on in that time. We had 14% inflation, 21% interest rates. Paul Volcker took over the Fed. We had U.S. hostages in Iran, Soviet troops in Afghanistan, a quadrupling of oil prices, and then a very deep recession. That was 1979, 1980. And that's probably a more similar historical model than the others. So you really need to pay attention to it. The other thing is what happened in 1980. Ronald Reagan was running for president of the United States. And in the Republican platform, there was a plank calling for a return to the gold standard. The return to the gold standard plank had been conceived of by Arthur Laffer, who was an economist who came up with supply-side economics, a discredited theory that basically was trickle down. Let's give a lot of money to wealthy people, and they'll spend money, and that'll help people who supply services and goods to wealthy people. But Art Laffer came up with this. Now, you have to remember, gold's fixed price against the dollar was changed in August of 1971 by Richard Nixon. So this is only 9 years into a period of floating currency exchange rates and freely floating gold prices that had determined the gold prices in the float after 1971 were not determined by a government diktat. Gold is worth $35 an ounce or $42 an ounce as they raised it after 1971. But rather, gold prices were determined in an international gold market that traded relatively freely, and the price was determined by all of the market participants collectively on an ongoing, continual basis. Now, some of the participants were larger than others, so they had more sway in that price, but it was a floating gold price. Art Laffer came up with a gold standard plank for the Republican platform. So the Republicans say, we're going to return to the security and safety and stability of a gold standard, which was a myth. The gold standard did not provide economic stability. Anybody who lived through the 50s and 60s knows that. And there are great books by Barry Eichengreen about how volatile the fixed exchange rates were and how volatile the economies were under them. Laffer's proposal was that the Reagan presidency, would say that it was restoring the 40% backing by gold of U.S. Treasury notes, U.S. Treasury bills that were circulated, that were produced by the government, would have gold covering 40% of their value of the outstanding Treasury notes. And he failed to point out that after 1971, the U.S. Treasury, by and large, stopped issuing Treasury notes. And most of the currency that was being created and circulated were Federal Reserve notes, which were specifically excluded from his gold standard. And I asked him after a couple bourbons about this, and he said, right, we can print money till the cows come home as long as it's Federal Reserve notes, but people won't mind, and they won't realize that this could have an inflationary effect because we'll be telling them that the Treasury notes are backed by gold. That's an important anecdote to know from way back in 1980, because it tells you how cynical and sinister government diktats and policymakers can be. I think that's very important given our current situation. Somebody sent me an email this morning. I'm not sure if it's true, but the email said that there is an old Turkish proverb that says, when a clown enters the palace, he does not become the king. The palace becomes a circus. I'm not sure if that's really an old Turkish proverb. It may be an hour old and come up with by somebody from Turkey, but it's a pretty apt proverb to kick around as we go forward. That's all I have for now. You can go to our website. You can buy our Gold Yearbook. We released it last week. It's a fabulous book. You should know it if you're going. You should have it. You should study it if you're going to be involved in the gold market as a commercial entity or as an investor. We'll be coming out with our silver book in May and our platinum group metals yearbook in July. You can go to our website, buy the book. It's $160. It comes immediately as an ebook. The last page says, if you want to print this book, take the PDF to a copy shop. Here are the specs to have it printed and bound. You can go to our website. You can see other free reads, free videos, various reports. You can read about our various reports. You can pre-order the gold, silver, and PGM reports. You can order the gold report. You can subscribe to our Precious Metals Monthly, and you can send us an email at info@cpmgroup.com and say, CPM Group, I'd like to talk to you about ways that you could help me have a more effective price exposure to gold, silver, and other commodities. Take care of yourself. Have a good weekend. We'll talk to you next week.